This content is for educational purposes only and does not constitute financial advice. Trading involves significant risk. Always do your own research and consult a qualified financial advisor before making any investment decisions. Ever notice how price hits the exact same level on a chart, gets rejected, drops, comes back weeks later, hits that level again, gets rejected again, and drops again, almost like there's an invisible wall there? That's not a coincidence. That's not random. That's support and resistance. And it's arguably the most important concept in all of technical analysis. More important than candlestick patterns. More important than indicators. More important than anything else you'll ever learn about charts. Here's why. Every single candlestick pattern we've covered in this series, hammers, engulfing patterns, evening stars, all of them become 10 times more powerful when they form at a support or resistance level, and 10 times more meaningless when they don't. We've talked about this idea in every lesson so far. Location matters. Well, support and resistance is the location. But here's the problem. Most beginners draw support and resistance wrong. They draw too many lines. They treat it like an exact science. They get frustrated when price goes slightly past their level, and then they give up and say it doesn't work. It does work. You're just thinking about it wrong. Today I'm going to show you what support and resistance really is, how to find the levels that actually matter, and how to use them to plan trades like a professional. By the end of this lesson, you'll have a skill that makes every other tool in your toolkit more effective. Let's start with the basics. Support is a price level where buyers tend to step in. When price drops down to support, buying pressure increases and price bounces back up. Think of it as a floor. Price falls down, hits the floor, and bounces. Resistance is the opposite. It's a price level where sellers tend to step in. When price rises up to resistance, selling pressure increases and price gets pushed back down. Think of it as a ceiling. Price rises up, hits the ceiling, and falls. Now, why do these levels exist? Because of memory. The market has a memory. Traders remember where they bought and sold. Institutions remember where they placed large orders. And when price comes back to those same levels, the same behavior tends to repeat. Here's a simple example. Let's say a stock drops to $50 and then bounces strongly. Every trader who missed that bounce is now thinking, if it comes back to 50, I'm buying. Some of them set limit orders at 50, just waiting. So when price does come back to 50, all those orders activate, demand floods in, and price bounces again. That's support in action. It's not magic. It's just a lot of traders making the same decision at the same price. Resistance works the same way in reverse. If a stock runs up to $100 and gets rejected, traders remember. Next time it approaches 100, people start selling. They take profits. They short. And price gets pushed back down. The more times a level gets tested, the more traders are aware of it, and the stronger it becomes. A level that's been tested 3 or 4 times is far more significant than a level price touched once. Now, here's where most beginners make their first mistake. They open a chart and start drawing lines everywhere. Every minor swing high gets a line. Every minor swing low gets a line. And suddenly the chart looks like a spider web. You can't see anything useful because there are lines everywhere. Here's the rule: less is more. You want to find the major levels, the ones that really matter, not every little bump and wiggle. So how do you find the levels that actually matter? 3 criteria. First, look for levels where price has reacted multiple times. If price bounced off a level once, it might be support. If it bounced off that level 3 times, that's real support. Multiple touches confirm the level. Second, look for levels that cause significant reactions. A level where price touched and moved 5% is more important than a level where price paused for an hour and then continued. You want levels that actually change the direction of price. Third, look for recent levels. A support level from last month is more relevant than one from 2 years ago. Markets evolve, traders change. Recent levels carry more weight because the traders who created them are still in the market. When you combine these 3 criteria, you typically end up with 2 to 4 key levels on any chart. Not 20, 2 to 4. That's all you need. And those are the levels where you should be focusing your attention. Here's the second big mistake beginners make, and this one costs people real money. They treat support and resistance as exact prices. They draw a line at exactly $50 and expect price to bounce at exactly $50 down to the penny. That's not how it works. Support and resistance are zones, not lines. Think of them as areas where buying or selling pressure tends to increase, not a single price, but a range of prices. Why? Because not every trader places their order at the exact same price. Some buy at 50, some buy at 49.80, some buy at 50.20. All of those orders together create a zone of support, not a single line. So when you draw support and resistance on your chart, draw it as a band, a shaded area, not a precise line. Give it some width, maybe a dollar range on a daily chart, maybe a few cents on a 5-minute chart. The time frame and the asset will determine the width. This is important because if you treat these levels as exact lines, you'll constantly be frustrated. Price will poke below your support by a few cents, trigger your stop loss, and then bounce right back up without you. Sound familiar? That's because your support was too precise. If you had drawn it as a zone, you would have placed your stop below the zone, not right at the line, and you'd still be in the trade. Think of support and resistance like a mattress, not a concrete floor. When you drop a ball on concrete, it bounces at exactly the surface. When you drop it on a mattress, it sinks in a little first, then bounces. The mattress has some give to it. That's what support and resistance zones look like on a chart. Now here's one of the most powerful concepts in all of technical analysis, and once you understand it, you'll start seeing it everywhere. When support breaks, it becomes resistance. And when resistance breaks, it becomes support. This is called role reversal, or a polarity flip. Let me walk you through why this happens. Imagine there's strong support at $50. Price has bounced off 53 times. Lots of traders are buying at 50. It's a well-known level. Then one day price breaks below 50. Now every single trader who bought at 50 is underwater. They're sitting on a loss. And what do losing traders do? They look for a chance to get out at break even. So when price rallies back up to 50, all those trapped buyers start selling. They're just trying to get out. That massive wave of selling is what turns the old support into new resistance. The same thing works in reverse. When resistance at $100 breaks and price pushes above it, all the traders who sold at 100 are now wrong. If price comes back down to 100, buyers step in because they know that the previous ceiling has been broken. The old resistance becomes new support. This is incredibly useful for trading. When you see a level break, don't chase the move. Wait for the pullback to the broken level. That pullback, that retest of old support as new resistance or old resistance as new support, is one of the highest probability trade setups you can find. It's a favorite among institutional traders for a reason. Quick pause. Whether you're upgrading your career, changing jobs, or applying for the first time, make sure your resume stands out. Check out Resume Zenith. Clean, professional resumes, built fast. Link is in the description. Alright, hit that like button, subscribe if you haven't already, and tap that bell so you never miss a lesson. Let's get back to it. So you've identified your key levels. You know they're zones, not lines. You understand role reversal. Now let's talk about how to actually trade around these levels. There are two main approaches, the bounce trade and the breakout trade. The bounce trade is the more conservative approach, and it's where beginners should start. Here's how it works. Price approaches a support zone. You wait for a candlestick confirmation, something we've covered in earlier lessons, maybe a hammer, maybe a bullish engulfing pattern. If you get that confirmation at the support zone, you enter long. Your stop goes below the support zone. Your target is the next resistance level above, or at minimum 2 times your risk. Same thing at resistance, but in reverse. Price approaches resistance. You wait for a bearish confirmation, a shooting star, a bearish engulfing, an evening star. If you get it, you enter short. Stop above the resistance zone. Target is the next support below or 2 times risk. The key rule: never trade a bounce without candlestick confirmation. Don't just buy because price touched support. Wait for the market to show you that buyers are actually stepping in. The confirmation is your evidence. The breakout trade is more advanced and riskier. Instead of trading the bounce, you wait for price to break through a level. If resistance breaks, you buy the breakout. If support breaks, you sell the breakdown. But breakouts are tricky because many of them are false. Price breaks a level, sucks in breakout traders, and then reverses. That's why a lot of experienced traders prefer to trade the retest. Wait for the breakout, then wait for price to pull back and retest the broken level. If it holds as new support or new resistance, that's your entry. It's slower, and sometimes you'll miss the trade entirely, but when it works, you have much better confirmation and a tighter stop. Before we wrap up, let me cover the 3 biggest mistakes I see traders make with support and resistance. Mistake number 1, drawing too many levels. If your chart has more than 4 or 5 horizontal levels, you have too many. The goal is to find the key levels, the ones that really stand out. If a level only caused a minor reaction once, it's probably not worth marking. Strip it down. Keep only the levels that are obvious. Mistake number 2, using exact prices instead of zones. We covered this, but it bears repeating because it's that important. Support and resistance are areas, not lines. Give them room. Use a zone. This alone will improve your results dramatically because you'll stop getting stopped out by wicks. Mistake number 3, ignoring the bigger picture. A support level on a 5-minute chart is much less significant than a support level on a daily chart. Always check the higher time frame first. If you're trading the 1-hour chart, at minimum check the daily chart for major levels. Those daily levels will override anything you see on the lower time frame. And here's a bonus tip. The best support and resistance levels are the ones that are obvious. If you have to squint at the chart to see the level, if you have to convince yourself it's there, it's probably not a significant level. The levels that matter are the ones that jump off the screen. They're obvious, they're clean, and every trader looking at that chart can see them. Now let me show you how everything we've learned so far fits together. This is the payoff. In Lesson 5, you learned market structure. Is the chart trending up, trending down, ranging, or choppy? In Lessons 3 and 4, you learned bullish and bearish reversal patterns, and now in this lesson, you've learned support and resistance. When you combine all three, you get confluence, and confluence is where real trading happens. Here's what a high probability setup looks like. The chart is in an uptrend, making higher highs and higher lows. Price pulls back to a support level, a level where it's bounced before, and at that support level, a bullish reversal pattern forms, like a hammer or a bullish engulfing candle. 3 factors all pointing in the same direction. Uptrend, support, bullish pattern. That's confluence. That's a setup worth risking money on. Compare that to a random hammer in the middle of nowhere, with no trend context and no support level nearby. Same pattern. Completely different probability. The pattern doesn't change, the context does. This is what I mean when I say context is more important than patterns. The pattern is just the trigger. The context, market structure plus support and resistance, is what tells you whether to pull that trigger or not. From this point forward, every trade you consider should pass this test. Do I have structure, level, and pattern all aligned? If the answer is yes, you have an edge. If any one of those is missing, the probability drops significantly. Homework time. And this one is going to tie everything together. Pull up TradingView, it's free. Open any 3 charts. For each one, I want you to do 3 things. First, do the 30-second chart read from Lesson 5. Identify the market structure. Second, draw only the key support and resistance zones, not lines, zones. Maximum 4 per chart. Look for levels with multiple touches and significant reactions. Third, look for any candlestick patterns forming at those levels. Don't trade them. Just observe. Ask yourself, is there confluence here? Does the pattern line up with the structure and the level? Do this on 3 charts and write down what you see. The act of writing it down forces you to think through each setup properly. It's the difference between passively looking at charts and actively training your brain to spot opportunities. I've put everything from this lesson into a free cheat sheet. How to identify real support and resistance, the zone approach, role reversal rules, the bounce and breakout trades, and the full confluence checklist. Go to candlelogictrading.com, drop your email, and I'll send it to your inbox. Keep it next to your screen. Next lesson, we're going to focus on a single candle that most traders completely misunderstand, the doji. It looks simple, a tiny body with wicks on both sides, but what it tells you about the battle between buyers and sellers is incredibly powerful, especially when you know where to look for it. One candle, one signal, and it can predict reversals before they happen. That's Lesson 7. New lessons drop every Sunday, Tuesday, and Thursday. Hit that like button, subscribe if you haven't already, and tap the bell so you never miss a lesson. I'll see you in the next one. This content is for educational purposes only and does not constitute financial advice. Trading involves significant risk. Always do your own research and consult a qualified financial advisor before making any investment decisions.